Hi everyone, we are Group 3 and in this video we will perform a financial analysis of Amplifon SPA. First, we will give a general review of the company along with the market analysis. Next, we will explain the financial and economic reclassification that we performed in order to then develop the company's solvency, liquidity and profitability analysis. Finally, we will analyze Amplifon's major competitors, comparing the financial ratios of these companies, thus providing a general review of the industry. Amplifon SPA was founded in Milan in 1950. It's a retailer of hearing care products and services, listed on the Milan Stock Exchange since 2001, and quickly embarked on an internationalization strategy that looked beyond national borders and today is present in as many as 26 countries, with more than 90,000 outlets, including franchises, corporate and corner shops. An excellent focus on innovation and customer care are the heart of Amplifon's success today, where solutions devised in-house, such as Amplifon 360 protocol and data-driven approach, have enabled the company to achieve extraordinary results, both in terms of growth, with the company present on every continent, and in economic and financial terms. To date, the company records revenues of 2.3 billion and EBITDA of 542 million, while the net income stands at 165.8 million. The retail market is extremely fragmented, but Amplifon has the 13% of market share. Less than 50% is attributable to small independent players, about 25% is held by vertically integrated manufacturers, and 10% by non-specialty players, such as pharmacies and supermarkets, and then less 3% for online retailers. As we can see, in order to conduct the financial analysis of the company, we proceeded with the financial and economic reclassification of the company's financial statements. With regard to financial reclassification, in order to understand the correlations between the time it takes the company to obtain liquidity from uses and the time it takes to pay back sources, we distinguished assets and liability according to the financial profile. Specifically, assets were reclassified according to the time for uses to return to cash, while liabilities according to the time after which the sources expires and must be extinguished. Regarding economic reclassification, it is conducted for the purpose of gaining a clearer view of financial and corporate profitability perspective. Specifically, the reclassification is carried out by dividing the statement into operating area for operation inherent to the typical purchase production sales cycle, extra operating area referring to the operations that are not part of the company's core business, financial area for operations necessary to finance operating and extra-operating activities, and extraordinary area related to extraordinary events. In the economic balance sheet, assets and liabilities are distinguished according to management criteria. Uses are distinguished according to performance, while liabilities are classified in relation to cost and remuneration. Solvency analysis is performed by comparing long-term sources and fixed assets to balance inflow and outflows in the medium-long term, and test the entity's ability to overcome any adverse events, internal or external, in the medium to long term. In this regard, we selected the most representative indices of the company financial situation. As a first indicator, we analyzed the secondary structural ratio, calculated through the ratio of permanent liabilities to fixed assets. A decrease from 0.96 to 0.84 from 2018 to 2022 indicates the ratio of equity plus long-term debt to fixed assets is decreasing. Although this may suggest less protection of the long-term debt with fixed assets, this ratio alone does not necessarily signal reduced solvency if the company has sufficient current assets to balance fixed assets. The second index is the degree of asset rigidity, obtained through the ratio of fixed assets to invested capital. The constant ratio around 0.82 and 0.83 indicates that the proportion of fixed assets to invested capital is stable, implying a constancy in the level of asset rigidity. This could represent a risk if the company needs liquidity rapidly because it takes more time to convert assets into cash. Next, we analyze the degree of Amplifon's financial autonomy to check the company's level of debt. We then analyze the ratio of equity to invested capital, which reflects the percentage of the company's financing from equity compared to the total financing, which includes both equity and debt. The increase from 0.27 to 0.29 shows an increase in equity relative to invested capital, suggesting that the company is relying more on its equity to finance operation. This is good for solvency as it indicates less dependence on external debt. On the other hand, as we can see in the second graph, which represents the structural indebtedness obtained through the ratio of consolidated and current liabilities on invested capital, there's a decrease from 0.73 to 0.71. in long-term debts over invested capital that might suggest that the company is managing its long-term debts better, which is favorable for solvency, and confirm that the company is less dependent on external debt. Finally, we analyze the total debt ratio and the financial debt ratio. Regarding the former, the decrease from 2.72 to 2.44 indicates that the total debt has decreased as a proportion of equity, potentially improving solvency as the companies may be less exposed to risk from a high debt load. In fact, in the financial debt ratio, the reduction from 1.54 to 1.12 shows a significant improvement in the proportion of financial debt to equity, signaling that the company has improved its ability to cover financial debt with equity. In conclusion, all these indicators together suggest that the company is improving its solvency with an increase in its financial autonomy and an improved debt structure that better position it to meet its financial obligation of the long term. Next, we perform the liquidity analysis, which is the analysis of the company's ability to meet short-term obligation through existing liquidity and expected short-term inflows. We then analyze the current ratio and the quick ratio. The former compares current assets with current liabilities, and Amplifon shows a decreasing trend from 0.85 to 0.56 from 2018 to 2022, indicating that the company has fewer current assets available to cover current liabilities. Specifically, the balance sheet showed that the current assets over the years increased by 100 million, while liabilities increased by 6 times. Although the ratio is less than 1, suggesting that the company may have difficulty meeting its short-term obligation with current assets, this is not necessarily a red flag if it can effectively convert its liability into cash, as indicated by the cash conversion cycle. The quick ratio is also decreasing, indicating that, excluding inventory, the company has less immediate liquidity than short-term liabilities. This may suggest vulnerability if the company faces sudden obligation. However, the company exhibits a cash conversion cycle that becomes increasingly negative, showing excellent working capital management, demonstrating that it's able to finance its operating cycle through deferred payments to suppliers, meaning that it has cash on hand before having to pay for inventory. In summary, although the current ratio and quick ratio suggest a potential strain in the company's immediate liquidity resources, the negative and improved cash conversion cycles provide a significant counterbalance. It demonstrates that the company is effectively managing its payment and collection cycles, allowing it to operate with less cash on hand and potentially investor pay off debts with the actual generated by operation before accounts are due. Thus, although the first two ratios may indicate some caution, the negative cash conversion cycle signals that the company has efficient management that can offset seemingly tighter liquidity. The last analysis we performed is that of corporate profitability, that is the ability of a given company to operate at equilibrium in the medium to long term. We then calculated the return on investment through the ratio of operating income to the net invested capital, which indicates how effectively a company uses its invested capital. Amplifon shows fluctuations of the period 2018 to 2022, with a peak in 2021. This might suggest that the company was able to generate a higher return from its investment in that year. The decline in 2020 could be due to the market challenges or investment that did not return expected, such as COVID. However, the recovery in 2021 and the subsequent slightly decrease in 2022 suggest that the company has maintained a relatively sustainable level of effectiveness in the use of invested capital. Instead, in the graph on the right, we have return on equity, which indicates how much profit a company generates with shareholders' money. ROE fluctuates slightly but shows a downward trend from 2018 to 2022, going from 17.96% to 17.64%. This due to the fact that, as we can see, equity has grown more than net profit because of retained earnings. In summary, the data shows that the company has shown a good ability to manage an invested capital over time, albeit with slight reduction in efficiency in terms of shareholder returns. In addition, the company has improved its ability to repay debt, which is a positive sign for its financial stability and long-term sustainability. An increase in equity may also indicate a stronger financial position and less reliance on debt, but also that the company may not be taking full advantage of leverage to increase return to shareholders. In summary, while ROE has declined slightly, this does not necessarily indicate lower company performance. Rather, it may reflect a company that is growing and capitalizing more. The management and effective use of growing equity are key aspects that the company must monitor to ensure that the additional capital is generating an adequate return on investment. For the purpose of having a more complete reading of the company's situation, we analyzed Amplifon's major competitors, comparing their indexes with those of the reference company. Specifically, the companies selected are Sonova and GN Store Nord, which are both manufacturer vertically integrated but globally present. This gives us a better benchmark because the companies which are only retailer are only locally recognized. Sonova has its headquarters in Switzerland, where it was founded in 1947. It develops, manufactures, and market advances hearing care. GN Store Nord is a Danish audio solution company, was founded in 1869 and is based in Denmark. The company focuses on the human auditory systems, sound and speech, wireless technologies, and software development, combining insights and knowledge from both the hearing aid and headphone industries. As we can see, here we have reported the most important indices of the two competitors from 2018 to 2022. From a profitability point of view, by analyzing the ROE of the three companies, Amplifon is showing more consistent stability in ROE than the other two companies, with a slight decline in 2020 but a subsequent recovery in 2021. In terms of solvency and financial sustainability, Amplifon appears to be less volatile and presumably less risky than the other two competitors in the long run, considering the fluctuating economy environment that may have affected the industry in which they operate. However, the slightly declining ROE in 2022 may also suggest the need for attention to ensure that the company continues to manage its capital efficiently. In addition, Amplifon shows a fairly stable ROE trend. Thus, in terms of return on investment, Sonova shows the best performance with steady growth in ROE. Amplifon, despite slightly instability, shows signs of recovery and improvement. GN, on the other hand, has significant concerns following the drastic decline in ROE in 2022. From a liquidity point of view, comparing the current and quick ratios, Amplifon shows some volatile in its quick ratio. The drop in 2022 to 0.550 suggests the reduced ability to cover current liabilities, not only because the lack of inventories, because the current liquidity ratio is still only 0.56. GN has already had a quick ratio above 1, except in 2022, when it fell to 0.50. Sonova showed great strength in 2020, with a quick ratio of 1.85, suggesting the strength of immediate liquidity management. Sonova appears to have the most balanced management of immediate liquidity, despite fluctuation, maintaining ratio generally above 1. Amplifon and GN, both a quick ratio of 0.50 in 2022, can be considered to be in a less favorable position, potentially indicating great vulnerability in their ability to meet current liabilities without relying on inventory sales. This is particularly critical for companies that may have sudden liquidity needs or operate in markets with volatile sales or collection cycles. Then, analyzing the total debt ratio, Amplifon has shown a relatively stable trend over the years, with a slight downward trend indicating an improvement in the debt-to-equity ratio. This could suggest prudent financial management and is a possible strengthening of the company financial position. GN had a low debt structure initially, but it has seen a gradual increase over time. The 2022 figure shows an increase from 2018, which could indicate an increase in debt relative to equity or a less significant strengthening of equity than an increase in debt. Sonova started with the lowest debt structure among the three, but showed a steady increase until 2020, followed by a slight decrease in 2021 and an increase again in 2022. However, the value remains at lowest among the three companies, suggesting that it has maintained a good financial discipline relative to debt, or has had proportionally greater equity growth than debt. Finally, analyze the indebtedness structure. Amplifon over the 5 years been stable, tending to decline. The value is around 0.7, indicating a strong reliance on debt for capital financing. The GN over 5 years shows an increase in value from 0.3 to 0.5 due to a strong increase in debt, still lower than Amplifon. Sonova shows an increased debt structure rate over 5 years from 0.14 to 0.33, indicating an increase in reliance on debt. Thus, while Sonova and GN show a tendency to increase their debt structure, Amplifon to tend to decrease it. In conclusion, with the solvency analysis, Amplifon has shown a gently decrease in the total debt ratio and its structure of indebtedness, reducing its debt structure. While, for the liquidity analysis, Amplifon's liquidity may face potential challenges in meeting its short-term liabilities. And then, in the profitability analysis, Amplifon has demonstrated stability in its ROE and some fluctuation in its ROE.